Hello and welcome to Financial Cake. Have you ever wondered why your grandparents talk about buying a loaf of bread for just a few cents? Or why the stories of an entire meal costing less than $1 sound like fairy tales today? It's not just nostalgia. It's a powerful, often invisible force that is constantly eating away at the value of your money. This force is called inflation. Today, we're going on a journey through time to see this phenomenon in action. We'll visualize how your purchasing power has eroded over decades, using real historical data from the United States, the United Kingdom, and Nigeria. We'll uncover the hidden mechanics of inflation, explore the surprising reasons why governments not only allow it but sometimes encourage it, and most importantly, we will reveal the specific assets that have historically served as a shield, protecting wealth against this silent erosion. Let's start with a simple thought experiment. Imagine you have a $100 bill in the year 1970 in the United States. You feel pretty well off. You could take that bill and buy a mountain of groceries, fill up your car's gas tank multiple times, and still have change left over for a night at the movies. Now, fast forward to today. That same $100 bill is still a $100 bill. It looks the same, feels the same, and has the same number printed on it. But what can it actually buy you? Maybe 1 week's worth of groceries if you're careful, or a single tank of gas for a larger vehicle. That cinematic night out might consume a significant chunk of it. The piece of paper is the same, but its power, its ability to command goods and services, has dramatically diminished. This loss of purchasing power is the very essence of inflation. It's the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Think of it as a slow leak in the tire of your wealth. Let's look at the hard data from the United States. Using the Consumer Price Index, or CPI, which measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services, we can see this clearly. What $100 could buy in 1970 would require over $780 today. That's a staggering increase of over 680%. Your money has lost the vast majority of its value. The story isn't just about the past, it's an ongoing process. Even over a shorter period, the effect is significant. What $100 could buy just 20 years ago, in the early 2000s, now requires about $175. This isn't a uniquely American phenomenon. Let's cross the Atlantic to the United Kingdom. Imagine having £100 in 1980. This was a substantial amount of money, capable of covering a family's expenses for a good while. Today, you would need approximately £450 to have the same purchasing power as that £100 from 1980. This demonstrates that over the last 4 decades, the British pound has also seen its value steadily eroded by the persistent march of inflation. The effect is even more pronounced when we look at economies that have experienced periods of higher or more volatile inflation. Let's take Nigeria as an example. The Nigerian naira has faced immense inflationary pressures over the years. In the year 2000, having 10,000 naira was a considerable sum. But due to high and often double-digit annual inflation rates, its value has plummeted. Today, that 10,000 naira has a fraction of its original purchasing power. You would need many times that amount to buy the same basket of goods you could in the year 2000. This global perspective shows us that no matter the currency, dollar, pound, or naira, the story is fundamentally the same. If left in its basic form as cash, money loses value over time. So, this brings us to a critical question: if inflation is so destructive to our savings, why on earth do governments and their central banks allow it to happen? In fact, why do most central banks, like the US Federal Reserve or the Bank of England, actively target a specific rate of inflation, usually around 2% per year? It seems counterintuitive, like a doctor prescribing a mild, chronic illness. But there are several complex economic reasons behind this policy. The primary one is to avoid the opposite and far more dangerous economic condition: deflation. Deflation is a general decrease in the prices of goods and services. On the surface, this sounds wonderful. Who wouldn't want things to get cheaper? But in reality, it can be catastrophic for an economy. If people expect prices to be lower tomorrow, they will delay their purchases. Why buy a new car, a new laptop, or even new clothes today if they will be cheaper next month? This widespread delay in spending causes a massive drop in demand. When demand collapses, businesses see their revenues dry up. They respond by cutting production, laying off workers, and reducing wages. This leads to higher unemployment and less money in people's pockets, which further reduces demand, causing prices to fall even more. This creates a vicious downward spiral that is incredibly difficult to escape, as seen during the Great Depression in the 1930s. A small, stable, and predictable amount of inflation encourages people and businesses to spend and invest their money rather than hoard it, keeping the economic engine humming along. Another reason governments tolerate inflation is that it can help to reduce the real value of debt. This applies to individuals with mortgages or loans, but more significantly, it applies to the government itself, which often carries enormous national debts. If a government owes $1 trillion, and inflation runs at 2% for a year, the real value of that debt has effectively been reduced. The amount of money owed doesn't change, but the value of that money does. Inflation makes it easier, in real terms, for governments to pay back their long-term debts. So, we have this constant, government-sanctioned force that is designed to slowly devalue our cash. Sitting on a pile of money in a savings account is like holding an ice cube in the sun. It might look solid, but it's constantly melting away. This is the core challenge for anyone looking to build and preserve wealth. You're not just trying to grow your money, you're in a race against the clock, or race against inflation. The question then becomes, how do you win this race? The answer lies in owning assets. You need to convert your cash, which loses value, into things that tend to gain value, or at least hold their value, over time. Historically, certain asset classes have proven to be powerful shields against the ravages of inflation. Let's explore the most prominent ones. The first and perhaps most well-known is real estate. Property has long been considered a classic hedge against inflation. When inflation rises, the cost of building new homes increases, including materials and labor, which in turn drives up the value of existing properties. Furthermore, if you own a rental property, you can typically increase the rent you charge to tenants over time, often in line with or even exceeding the rate of inflation. This means your income from the asset also keeps pace, protecting your cash flow's purchasing power. For decades, home ownership has been a primary way for families to build wealth that outpaces inflation. Another powerful asset class is stocks, or equities. When you buy a stock, you are buying a small piece of ownership in a real, operating business. These businesses sell goods and services, and as inflation pushes up the prices of those goods and services, the company's revenues and profits tend to rise as well. A well-run company can pass on its own increased costs for raw materials, energy, and wages to its customers in the form of higher prices. This pricing power allows its earnings to grow with inflation, and over the long term, this growth in earnings is reflected in a higher stock price. Of course, the stock market is volatile in the short term, but over long periods, major stock market indices like the S&P 500 have historically delivered returns that significantly outpace the rate of inflation, leading to real growth in wealth. Then we have commodities. These are raw materials or primary agricultural products, such as oil, natural gas, grains, and precious metals. The prices of commodities are often a direct component of inflation itself. When the price of oil goes up, the cost of transportation and manufacturing rises, pushing up the prices of many other goods. Because of this direct link, commodities can be a very effective short-term hedge against unexpected spikes in inflation. However, they can also be extremely volatile and don't produce any income on their own, making them a more speculative tool for most investors compared to stocks or real estate. Within the commodity space, gold has a special, time-honored status as a store of value. For thousands of years, in cultures all over the world, gold has been seen as a safe haven asset. It's durable, rare, and has an intrinsic value that is not tied to the policies of any single government or central bank. When people lose faith in paper currencies during times of high inflation or economic uncertainty, they often turn to gold. This increased demand drives up its price, helping to preserve the purchasing power of those who hold it. Finally, in more recent times, we have seen the emergence of new asset classes like cryptocurrencies, with some proponents arguing that assets like Bitcoin could serve as a form of digital gold. The argument is that its fixed supply, capped at 21 million coins, makes it inherently resistant to the kind of debasement that affects government-issued currencies. This is a newer and much more volatile asset class, and its long-term effectiveness as an inflation hedge is still a matter of debate. However, its performance during recent periods of high inflation has certainly caught the attention of many investors looking for modern alternatives. The key takeaway is this: you cannot afford to be passive with your savings. The system is designed in a way that holding cash over the long term is a losing strategy. The value of your hard-earned money is guaranteed to decline. Understanding inflation is the first step. Realizing that you must convert that cash into productive assets is the second and most crucial step. Whether it's the stability of property, the growth potential of stocks, the raw value of commodities, or the modern promise of digital assets, the goal is the same. You need to own things that are not just pieces of paper with a number on them. You need to own a piece of a business, a piece of land, or a piece of a scarce resource. These are the things that have real, tangible value in the world. And as the general price level of everything else rises around them, their value tends to rise too, creating a powerful shield that not only protects your wealth from the silent erosion of inflation but allows it to grow in real terms, securing your financial future. I hope this has helped you understand the invisible force of inflation and, more importantly, how you can protect yourself from it. Thanks for watching. If you found this video helpful, please consider subscribing to Financial Cake for more insights into building and protecting your wealth.